This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Rising rates as Treasury yields move higher. Will the red-hot bull run in the stock market start to cool?
And then there were two. 87-year-old Warren Buffett is one step closer to naming his successor after elevating two key figures at his sprawling conglomerate.
Newman's own tax trouble. The well-known brand faces a 200% tax hike and a lot of questions now about its future. Those stories and more tonight on Nightly Business Report for Wednesday, January 10th.
Good evening, everyone, and welcome. Stocks faltered a bit today after a strong start to the year. The S&P 500 and the NASDAQ closed lower for the first time in 2018. Now, some are attributing the decline to good old-fashioned profit-taking. Others, though, pointed to nervousness that higher inflation could force the Fed to be more aggressive when it comes to hiking interest rates. The result was a drop in stocks. The Dow fell 16 points to 25,369. The NASDAQ was off 10, and the S&P 500 was down 3. Investors are also paying more attention to the bond market these days. Yields have been rising, and that could usher in big changes for stocks and the economy. Steve Leisman explains.
Interest rates are rising, presenting a challenge to economic growth and to the stock market. But some look at the recent rise and ask, what took so long? The Fed hiked interest rates 3 times last year, and the 10-year bond yield barely budged. It actually fell for much of 2017. The recent rise comes amid a report that China, a big buyer of U.S. bonds, is rethinking how much it buys. It also comes amid better growth, a rise in inflation expectations, and a coming boost to the deficit from the tax cut bill. All those factors had many thinking that rates should really be higher, not lower.
Yields are low. They are rising. They should be higher. They're nowhere near where they ought to be given the economic environment, given the global central bank pressure on keeping rates low.
The rate increases represents a modest problem for companies. Corporate bond yields have risen, so some of the tax cut benefits could be reduced by higher rates paid by corporations. Mortgage rates have also ticked up, but the gains have been modest, and rates still seem to be available around the 4% rate for would-be homeowners. The problem for the market? Do some investors think a 10-year yield of around 2.6% is a better bet than buying stocks, meaning they pull money out of equities? But this does solve a problem for the Federal Reserve. Some officials were starting to be concerned that rates in the broader economy were failing to respond while it was hiking the short-term funds rate and reducing its balance sheet. A higher long-term yield should give the Fed some comfort that its rate hikes are filtering into the economy and it's still in the game. For Nightly Business Report, I'm Steve Leisman.
Well, the great bond bull market that began 25 years ago may be coming to an end. So says Janus Henderson's Bill Gross, who is often referred to as the bond king.
It's not a strong Colombian bear market. It's a decaffeinated bear market where yields on the 10-year probably rise by 10 to 20 to 30 basis points for the year. But nonetheless, it means that yields are probably moving higher as opposed to lower.
But rising rates don't necessarily mean falling stocks, at least not according to Bill Miller, who is known for beating the market 15 years in a row when he worked at Legg Mason.
Those 10-year yields go through 260 and head towards 3. I think we could have the kind of melt-up we had in 2013, where the market was up, 30%.
Well, rising interest rates are sure to be a theme this year, but what impact might they have on companies and their stock price? That's up for debate. One of our guests says rising rates pressure stock valuations. The other says it's a win for certain sectors of the market. Here with us to talk about how rising rates might hurt stocks is Christina Hooper, global market strategist at Invesco, and Steve Dudash is president of IHT Wealth Management, joining us to take the other side of that debate. Welcome to both of you. Pleasure to have you here.
Thank you.
Christina, I'm going to start with you. You think it might put pressure on profit margins at current interest rate levels, or if they move decidedly higher?
If they move decidedly higher, borrowing costs are going to increase, and that will definitely put pressure on profit margins, in addition to other pressures we're likely to see, like an increase in wages.
All right, so let me turn to you, Steve. You say, among other things, that on the whole, rising rates are going to be a net positive for equities. I can see where it's going to help financial companies. Their net interest margins will expand as they're able to charge more because, by the way, they usually charge more for loans than they pay you in deposit accounts. But how else is it going to help stocks?
Well, okay, let me take a slightly different approach. If we're not going to raise interest rates, when are we? We just came off a year with the markets up 20%, 3% GDP, and unemployment, very, very low right now. What else do we need to do in this Goldilocks period to make people comfortable with a rate hike? Our economy is better off if we rise our rates just a little bit. I'm not talking about get back to where we were in the 70s or 80s, but raise rates a little bit and give us that ammo in the gun for when the next recession comes or the world event or whatever. We all know it's going to happen sooner or later. Gives us some protection knowing that we have ammo for when that takes place. If something bad happened today, we don't have a lot of wiggle room to protect us or to help out on that. So get rates up there. I mean, again, we're at 500-year lows in rates right now. A little bit more of a rate hike isn't going to really hurt things in the long term that much.
Christina, let's talk about the point that Steve just made about the fact that if indeed we do have a market event, that it gives the Fed a little bit more wiggle room. Others say rising rates complicates it for the Fed. What do you think?
Well, I think he's absolutely right that certainly you get some dry powder by raising rates, but that doesn't dismiss the fact that it does put pressure on valuations. When you think of major valuation models for stocks, the inputs are earnings or expected earnings and interest rates. And you're discounting the earnings by the interest rate. So if interest rates are higher, typically that will put pressure on valuations. Now, if you have modest rate increases, it won't have a very material impact, but it does have some, and it certainly has an impact on the bond market as well. Having said all that, it doesn't mean that it's not healthy to have a few rate hikes. We just have to be prepared for the fact that we could see some valuation compression if earnings don't deliver.
So address that, Stephen. I take your point, the idea that if not now, when are we going to raise interest rates with them this low? But my initial question was, explain to me how these higher rates are not going to hurt stocks, but in your view, may indeed actually help them go higher.
Okay. Your guess is 100% right. It's going to hurt valuations a little bit. There's no doubt about it. But we don't need another 20% market returns. I mean, don't get me wrong. Everyone's happy when the markets are up 20%. But that's not healthy. Bottom line profits didn't go up enough to justify what just took place. And if it happened again next year, we probably have an issue. So yes, rate hikes might hurt valuations a little bit. She's right on the math on that. And might bring down what the total returns might be in the market. But from the grand scheme of things, if we're trying to do this long term, if we're trying to grow this economy and add stability and do it the right way, we don't want 20% returns over and over again. If this hurts valuation, fine, who cares? We're better off in the long term through it if we have a single digit year. And she's right, it's going to hurt bonds. But that actually ends up helping the stock market because if people aren't making money on bonds or losing money on bonds, they're going to rotate into the stock market more, which props up returns on the stocks a little bit more than probably should take place.
All right. Well, the conversation is not over yet, certainly. We'll continue. Thanks so much for joining us. Christina Hooper with Invesco, Steve Dudash with IHT Wealth Management.
Well, the Federal Reserve delivered more than $80 billion to the Treasury Department. The central bank remits its profits to the Treasury every year. And while $80 billion sounds like a lot, it was the second straight year of profit declines, primarily due to rising short-term interest rates.
And speaking of billions, Warren Buffett's succession plan is getting a bit clearer. For years, many wondered who would fill the billionaire investor's shoes and lead Berkshire Hathaway. But now it's down to two men. Becky Quick is in Omaha for us tonight.
The news today is the closest we've ever gotten from Berkshire Hathaway in terms of a succession announcement about who would take over when Chairman and CEO Warren Buffett leaves. That news is that Greg Abel, who has been running Berkshire Hathaway in Energy, and Ajit Jain, who's been running Berkshire Hathaway Reinsurance, will each be taking over as vice chairman of the company. They will be promoted. That will be in addition to the existing vice chairman, Charlie Munger, who at 94 years old is going nowhere. He will still be staying there at the company. This will just be a promotion to put both Abel and Jain into these new positions. They'll also be joining the board of Berkshire Hathaway. That moves the number of directors there to 14 from 12. And that's something that Warren Buffett tells us will be very good for each of them to have to get that experience.
They're both got Berkshire in their blood. They love the company. They know their operations like the back of their hand. It's very good for Berkshire, and it's even better for me.
We also got the chance to ask Buffett about some of the individual holdings that Berkshire has, some of the major stock holdings. And right now, they don't have to tell us anything. They don't have to file with the SEC what they've been doing in the fourth quarter until February 15th. He was coy on what he thought about Apple.
We've added to our holdings consistently up through all the published reports, and we'll publish some more on see, the market is not yet saturated for iPhones. I just want to point that out. When Tim Cook sent me a Christmas card again this year saying he was going to sell me an iPhone this year, when I actually buy it, it's all over, folks.
As you can see, Buffett still has a flip phone that's made by Samsung that he keeps with him at all times, so we'll see if he ever actually does buy an iPhone. The other stock we asked him about was shares of General Electric. Berkshire is not a shareholder in shares of General Electric, but the question has been brought up, would it be something that he would eventually see or like at some price? Now, the answer is yes, at some price. The question is, what?
Different people have different views on what that price would be, but I mean, if you came to me and said, we'll sell you the whole General Electric company at X, and X was the right number, we'd like to buy it. And if we buy little pieces in the market, that's the way we think about it.
He did, however, say that he thinks GE is a big, strong company. For Nightly Business Report, I'm Becky Quick in Omaha, Nebraska.
Concerns about the future of NAFTA reverberated through parts of the stock market today. Reuters reported that Canada is becoming, quote, increasingly convinced that the U.S. will exit that long-standing trade agreement. And that sent shares of a Canadian and a Mexican ETF lower. GM also under pressure, as you see there, since it imports from Mexico some full-size pickup trucks, which are among its most profitable products. And Kansas City Southern, which has an extensive network in Mexico, was off 3.5%.
The clock is ticking for the Trump administration to take action on one of its key campaign promises, defending American manufacturers priced out of the Chinese market. And as Kayla Tausche reports, that action could possibly include some tariffs.
In his first 100 days, President Trump launched an investigation into steel and aluminum dumping under a rarely used national security statute. The hypothesis: Chinese state-owned companies with no penchant for profit flood the market with cheap commodities and put American companies out of business. Commerce Secretary Wilbur Ross must now decide whether such actions imperil American industries needed for war, and if so, how to penalize them. In the last 9 months, the issue has caused friction among advisors with varying viewpoints, some of whom have now left the White House.
I think there's a great struggle that's going on inside this administration.
Tom Conway represents the United Steelworkers Union.
We're going to rely on the president to do what he said, because you don't know who's working there anymore.
The president has 90 days after the commerce reports are due this month to make a decision. Industry observers expect it to be a tough one, citing his ramped-up criticism of China following his November visit.
We will not remain silent as American companies are targeted by state-affiliated actors for economic gain.
And a December national security strategy describing China as a dangerous competitor. Companies like Century Aluminum want to fight the imbalance with tariffs. CEO Mike Bless supports a levy of 20%.
There's 1 million tons of U.S. capacity representing thousands of jobs that's ready to restart as soon as a comprehensive relief is granted and the playing field is made level.
Relief may have its limits. U.S. allies would likely be excluded from tariffs, and they may be temporary in nature. Still, experts warn leveling the playing field for steel and aluminum could cause China to retaliate against U.S. farmers, throwing another industry off balance. For Nightly Business Report, I'm Kayla Tausche in Washington.
Still ahead, more issues for Apple over its older, slower iPhones and their batteries.
Two Japanese automakers will build a $1.5 billion plant in Alabama. Toyota and Mazda will together build a factory that's expected to employ about 4,000 people, producing 300,000 cars each year. That plant could make Alabama the fourth biggest state in the U.S. when it comes to auto manufacturing.
Well, get this. The lights went out at the world's largest consumer electronics show. Literally, they went out. The conference at the Las Vegas Convention Center's main hall was dark for about 2 hours. Who plugged in the hairdryer? The outage impacted hundreds of companies, including Samsung, Sony, LG, and it came just one day after it rained in the desert city, flooding the streets. The cause of the outage was a faulty transformer.
Apple last month admitted to deliberately slowing down iPhones with older batteries. That resulted in lawsuits, customer complaints, and now some questions from a U.S. senator. Josh Lipton has our story.
Apple's CEO, Tim Cook, made a decision last year that is now attracting a lot of attention. His company introduced new software which can slow the performance of iPhones with older, declining batteries. Apple says that was necessary because of a very real technical challenge. Batteries decline over time. As they age, they can have a tougher time handling the power demands of devices and can unexpectedly shut down. But Cook now finds himself fielding questions about this decision from powerful politicians on Capitol Hill, including Senator John Thune, chairman of the Senate Commerce Committee. Senator Thune questions whether Apple has been as forthcoming as it could have been regarding this issue.
Part of the thing that we want to get at is the transparency issue. If they deny that they're engaging in planned obsolescence, in other words, trying to force people to buy the next phone, but we want to make sure through our role as oversight that that's true.
Senator Thune sent Cook a letter demanding to know whether Apple tracks consumer complaints about processing performance and whether the company is exploring whether consumers who paid full price for a replacement battery before a recent price cut should now receive a rebate. What happens if Apple's answers aren't satisfactory? Senator Thune says that he could then call a hearing and, in his words, elevate this further. For its part, Apple counters that its critics are wrong, saying, "First and foremost, we have never and would never do anything to intentionally shorten the life of any Apple product or degrade the user experience to drive customer upgrades. Our goal has always been to create products that our customers love, and making iPhones last as long as possible is an important part of that." Apple's point is that it's not trying to force consumers to buy new iPhones by crippling older ones. It's just the opposite. It's taking steps to make those older iPhones last longer. Still, Cook's company finds itself facing questions on both sides of the Atlantic. In France, the Paris prosecutor's office has also reportedly opened an investigation into this issue. For Nightly Business Report, I'm Josh Lipton, San Francisco.
Lennar says demand is strong, and that is where we begin tonight's market focus. The nation's second largest home builder said buyers were eager to purchase new homes in the latest period at higher price points. The company beat revenue expectations, but it missed the mark when it came to profit, saying the delay of a strategic transaction caused that miss. Still, shares finished the day up 2% at 68.26. And after the bell, rival KB Home reported results that outpaced expectations. The company said profits were helped by an increase in average selling prices and an uptick in deliveries. Shares initially rose after hours and also finished the day up a fraction to $34.35. Medical device maker Intuitive Surgical excited Wall Street today with the release of its fourth quarter preliminary results. The company expects to report revenue that tops its own guidance as well as analysts' expectations. Shares up 6% to finish the day at $423.76.
The software company SS&C Technologies is reportedly in talks to buy DST Systems for more than $5 billion. Reuters says SS&C is interested in a potential deal so that it can expand its reach and enter the healthcare information technology market, which is a familiar space to DST. Shares of DST Systems popped 22% to $79.89. SS&C shares rose nearly 13% to $47.69. 21st Century Fox is reportedly close to finalizing a deal that will give it ownership of 10 TV stations operated by Sinclair Broadcast Group. According to Reuters, Sinclair made the move to win regulatory approval for its nearly $4 billion acquisition of Tribune Media. The deal gives Fox a presence in key NFL markets, potentially resulting in higher revenue. Shares of Fox fell more than 2% to $35.60. Meanwhile, shares of Sinclair jumped almost 9% to $38.75.
Well, banks have always been wary of working with the legal marijuana business, mostly because it is still illegal federally. Now, 1 week after the Attorney General announced a bit of a crackdown, that problem could be worsening. Kate Rogers reports.
Reaction to the crackdown has been mixed. Some in the pot industry are fearful. For others, it's been business as usual. One thing seems certain: the industry's already strained relationship with banks will become even more stressed. A recent report from industry analyst Greenwave Advisors estimates that just 5% of all financial institutions are working with cannabis businesses, but only 1% are actually servicing them. That means that pot businesses can't easily deposit money they've earned.
Before, banks were very reluctant to do any business based upon the loosely defined FinCEN guidance. Now it just raises more uncertainty.
That Cole memo was issued by the Obama administration to ease some of the stress between the banks and pot dispensaries. Banks were weary even then, but now could be even more so. Uncertainty could create an opportunity for the security industry. More cash not in banks requires more protection. Tony Gallo's Sapphire Risk Advisory Group in Dallas offers vaulting and security consulting. He's received calls from clients old and new in the past week seeking advice and new business.
A lot of our clients were concerned about whether their security is adequate at this time in their locations, whether it's a grow facility or a dispensary. And then current new clients that are looking to come on board wanted to know what kind of security are they going to be required to have going forward.
One thing Sessions' action didn't alter: growth projections for the industry. Industry watcher Marijuana Business Daily projects sales will hit $6 billion this year, with growth tripling over the next 4 to 5 years. And some say those numbers are conservative.
Basically, you have a freight train moving at 200 miles an hour, and Jeff Sessions is, jumping out of a bush trying to stick his leg in the way to slow this down, and it's just going to run him over. So I think that it might have some type of chilling effect in certain areas, but in general, the industry is going to continue moving and growing quickly and moving forward.
Despite new challenges, advocates, analysts, and entrepreneurs are all moving ahead with plans in this budding industry. For Nightly Business Report, I'm Kate Rogers.
Coming up, Newman's Own faces a massive tax bill and possibly an uncertain future.
Newman's Own is a different kind of company. It gives away 100% of its after-tax profits through a foundation started by the late actor Paul Newman. But that uniqueness is now getting complicated, and the company faces a massive tax bill. It's complicated. Ilan Mui explains.
One of America's favorite makers of pasta sauce is now finding itself in hot water. Newman's Own is facing a crushing tax penalty this year that company executives say will force them to put the business up for sale unless Congress can come up with a solution.
It's the way they can force you to break up the company, and I use those terms deliberately, that the only alternative to getting this legislative support, and again for us and for these other companies, is that we would have to divest Newman's Own.
Hollywood star Paul Newman established his namesake company more than 35 years ago. It's best known for making marinara sauce, but it also makes salad dressing, lemonade, and hundreds of other pantry products. It's now worth $500 million, and it's technically considered a for-profit company, even though all of its earnings are funneled into Newman's private foundation, which then uses the money to fund charities around the world. That model worked well while Paul Newman was alive, but after he died in 2008, an obscure provision of the tax code kicked in, prohibiting his private foundation from owning more than 20% of a for-profit company. So now, if the foundation doesn't give up control of the business, it will get hit with a fine worth 200% of the value of the company. Executives say there's no promising buyer yet.
The equity of the brand is about our social purpose, our 100% of profits to charity. So anybody trying to buy Newman's Own has to deal with that particular issue. And what will be the consumer's reaction if that company is not giving 100% of its profits to charity? It's hard to figure.
The Tax Cuts and Jobs Act is passed.
Congress tried to tuck some legislative relief for Newman's Own into the sweeping tax plan that passed late last year, but it was struck at the last minute for procedural reasons.
Good to see you. Welcome.
So today, top officials from Newman's Own came to Washington in hopes of finding an alternative, and fast. Executives say they need an answer by the end of the first quarter, or the credits could roll on Newman's Own. For Nightly Business Report, I'm Ilan Mui in Washington.
To read more about Newman's Own tax issue, head to our website, nbr.com.
We're going to keep track of that story.
It's a good story.
That is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And thanks from me as well. I'm Tyler Mathisen. Have a great evening, everybody, and we'll see you right back here tomorrow night.
Yep.